Friends, welcome to assignment 6 part 2 video tutorial. In the previous part of this assignment 6 tutorial we talked about the following sections. We talked about constants, how we use those constants in further calculations. We talked about inputs, which is the main area where you enter your parameters, and depending on those parameters certain financial indicators change, such as interest rate, or the percentage of loans on which consumers and corporate customers default, and so forth. Here we have summary of key results. I told you that we're going to skip this section for now because those key results they come from elsewhere. So in this part, and then we spend a lot of time talking about the calculation section, where we actually calculate all those percentages, all those interest rates that are used in further calculations. So in this part we'll talk about the two remaining parts, which is income statement and cash flow statement, and also short-term debt owed, and then the third one, which is final stress test computations. In a way, all of those parts, all of these three parts, they make use of the calculations that you did previously and that are available in this section. So we'll start with the biggest section, which is income statement and cash flow statement. Now, I explained to you before that income statement and cash flow statement are two different accounting documents. They are related, in a sense that high income, high profitability helps you replenish your cash reserves. Nevertheless, they are distinct. They are distinct concepts, because what you're doing in a cash flow statement, you're keeping track of your cash inflows and outflows. And I told you before that cash is very important when it comes to determining solvency of a business, meaning ability of a business to repay its short-term debt obligations. Now, income statement is a bit different because accountants, they keep track of sales and expenses on a non-cash basis, meaning that some revenues and some costs or expenses are recorded even though there is no corresponding cash inflow or outlay. And I give you an example of selling a tractor on credit. So if you own a store that sells tractors and you sell a tractor on credit, on a loan, it means that you record this transaction as revenue, as a revenue item. However, you don't have cash for the tractor yet because somebody promised you to pay cash, let's say in 5 equal installments over 5 years, right? So you record it as a revenue, but it's not on a cash basis. So in this section we combine those two statements, income statement and cash flow statement, into one, because the two are related. Although big corporations, they would separate income statement from a cash flow statement. So the starting point is something that is actually related to cash flows, not to income. So this item says beginning of the year cash on hand, meaning how much cash you have in the beginning of 2016. Now that is taken directly from this item, which is end of the year cash on hand. Okay, so whatever the cash reserves that you end your year with is the same amount that is available to you in the beginning of the next year. So from this amount, you do certain adjustments based on your revenues, meaning cash coming in. And by the way, those revenues, they seem to be on a cash basis. And the same thing for these expenses. They also seem to be on a cash basis. But again, not all revenue items and not all expenses involve cash. So the first thing you have, to this amount, you will add interest on consumer loans. And this is calculated by multiplying interest rate on consumer loans percentage by the total amount of consumer loans that you have for 2016. Interest on corporate loans, the same thing. You multiply the amount of corporate loans that you have for this year by the interest rate on corporate loans. And then trading account revenues, you have your trading account here, and I explained to you before that this is the value of the stock that you own as a bank, as a company. So you multiply this amount by the interest rate on trading assets. So those things become your revenues, and in total, by summing up, by adding those three numbers, you get this value. Okay. Now, what about expenses? Now, naturally, expenses, you deduct your expenses from your cash. Meaning, if you're paying for a particular expense with cash, it means your cash reserves go down. First of all, interest on deposits. You calculate it by multiplying interest rate paid on deposits, which is 1.5%. by the total amount of deposits. Basically, this is the money that consumers bring to your bank and you put into a savings account or checking account. So this is what they deposit, and if they deposit money with your bank, you need to pay interest rate. So this is how much you pay for that. Interest on short-term debt. You as an organization, you borrow money, in the short run, meaning like, you need a quick fix to your cash flow situation. So you borrow money from, let's say, another bank, and you pay 1.5% from on that loan. And this value, by the way, comes from this cell, which says beginning of the year short-term debt owed. So typically those are other banks. In other words, if you have like a small cash flow problem, you will borrow, let's say, for a few 1 year or a few months from another bank to make sure that you don't have a solvency problem. Interest rate on long-term debt. As an organization, you may also have a number of long-term loans that you take out for 5 or 10 years. Typically, economists define long-term anything longer than 5 or 10 years. So you get this amount by multiplying the interest rate on long-term debt by the total amount of long-term debt owed in the constant section. Trading account expense. Remember, I told you that you have some trading assets right here. Where is it at? Yeah, trading account assets, meaning you own stock and you also employ, let's say, certain brokers in your bank so that they do all the trading. They buy and sell stock depending on your trading strategy, depending on your investment goals. So this percentage represents out of your trading revenues, how much goes to expense. In other words, how much do you need to pay to those trading brokers, and what is the overall overhead for that trading account. So you multiply trading account revenues by this percentage that was calculated earlier, and this is your overall trading expense. So as you can see, you're making, for this particular year, giving these conditions, you're making some money because your overall revenues on your trading account is around 24 there's a billion. Yeah, it's in billions, and then your expense is 14 billion. Loan losses here. So it's 3%. So you have the following two amounts in consumer loans and corporate loans. You need to multiply it by 3% to find out how much money you will lose. Meaning some people simply don't repay their loans back. Some consumers default on their loans. And the same thing for businesses. They just default on their loans and they cannot pay you back, so you just need to write it off as an expense. And this is your total expense. Okay. You sum up all those expense items. Now your income before taxes becomes total revenues minus total expense. So that's your income before tax. And then income tax expense is calculated by multiplying this. Well, it's a bit complicated. It's a decision formula. But the essence is that, depending on how much income you have, you multiply this amount by your tax rate to figure out your tax amount owed. However, it's not that simple. There is some logic involved, which is the logic itself is not that complicated. It's implemented with one if statement. So if C48, meaning this cell, your overall income before tax, is less than 0, then your tax expense is 0, meaning you don't pay anything in tax if you don't make any money, if your profit is 0. Otherwise, if this is false, right? This is condition if true. If this condition is false, then you multiply this amount by your tax rate, which is found right here. So this is how you calculate tax expense, and that's how you get net income after taxes. Okay, by subtracting tax expense from income before taxes. So this is your net income after taxes. And this is your net cash position. Again, you started the year with 300 billion in cash, right? Because these numbers represent millions of dollars. And then you made a net income of 58 billion. So you add this amount to this amount. Again, it's simple because it's like these items are on a cash basis. If we had some expense or revenue items that were not on a cash basis, then you could not simply add net income after tax to your beginning of the year cash reserves to get your end of the year cash reserves. But here we can do that because everything is on a cash basis right here. So this is your net cash position before borrowing and repayment of debt. So it's beginning of the year cash plus net income. That's what you have. Now here we have an item called add increase in borrowing. So in other words, we need to see whether we need to borrow cash, borrow money, or we don't need to borrow. Again, it's a bit complicated. I mean, it makes it a bit confusing when you have those dashes. Those are basically zeros, so you can reformat those cells if you wish. You can go, instead of custom, you can have like just currency, something like that, okay? So basically what it says in this case, our increase in borrowing is 0. Now the reason it's 0 is that we have enough cash. I mean, look, we have 358 billion in cash. So we don't need to borrow anything, because remember, in order for us to start each year, we need 50 billion. So apparently we have way above that, so we don't need to borrow anything. Now the logic that is implemented here, along those lines is as follows. If C52 is greater than C5, and this is our cell, that's our net cash position. If this cell is greater than this cell, which is the amount of cash that we need to have at the beginning of each year, then increase in borrowing is 0, meaning we don't borrow anything. If, however, C5, this value, is greater than this value, then net cash position at the end of the year, which means that we don't have enough cash, we don't have 50 billion in cash to start the year, then we need to borrow the amount that is equal to the difference between 50 billion and whatever we have here, which is less than 50 billion, right? So let's say if we only have 40 billion of cash at the end of the year, then we don't have enough to start the year, so we need to borrow 10 billion. But in this case, we don't need to borrow anything. Repayment of debt, again, it's related to this cell and this cell. What it means, this is the logical test. If C58, one second. Yeah, if C58 equals to 0, right? So the repayment of debt is 0, meaning we don't owe anything, so we don't repay anything, okay? If C52 is less than C5, in other words, the amount of cash that we have on hand at the end of the year is less than the amount of cash that we need to start the next year, then it's 0, meaning, in other words, we don't have enough cash on our own, so we're not going to repay any debt obligations. However, if C52, if the difference between C52 minus C5, meaning the difference between the amount of cash that we have on hand and the amount of cash that we need to start the year, if it's greater than C58, in other words, if it's greater than the amount of short-term debt that we have, then we can repay something, okay? So in that case, if the difference is greater, then we can repay the entire amount outstanding, okay? If it's not greater, if this difference is not greater than the amount that we owe, then we need to repay the difference between C52 and C5. In other words, we'll repay whatever the amount that exceeds this value, okay? So that's the logic for calculating repayment of debt. And then, in this case, it equals 60, so we repay the entire amount. So this condition, C52 minus C5 is greater than C58. So basically, this amount is much greater than this amount, right? So C5, yeah. So in that case, we repay C58 value, meaning the total amount of debt outstanding. Okay. And then, once we repay that, this amount, the overall amount of cash that we have on hand is decreased by this amount, the amount of money we repay for our debt, right? So it's this value plus this. I mean, we don't borrow anything, so we just subtract this value, okay? But there are situations where we have to add this because this is like, increasing our borrowing. So that's the amount of cash that we have on hand, okay? So this is our cash on hand at the end of the year, okay, after all those adjustments, because here it's like net cash position before we make any repayment of loans. Now here we have short-term debt. So basically, beginning of the year short-term debt equals to the end of the year short-term debt from the previous year. So that's how we get this value. Here, increase in borrowing. Do we borrow something or not? So this value actually is linked to this cell. That's where we calculate using those if conditions. And here we have repayment of debt, again linked to this section. So this is like your balance sheet. It outlines the overall, not overall, but it gives you like a snapshot of short-term debt. Because again, I told you that short-term debt versus the amount of cash that you have is very important for determining solvency of your business, meaning determining whether your company can meet its financial obligations or not, whether it needs to declare bankruptcy or whether it's financially solvent. Okay. So here we have end of the year short-term debt owed, which is derived from these values. So it's beginning of the year, add whatever you're borrowing on the top. In our case, it's 0 dash, and then subtract any kind of repayment. So this is what you have at the end of the year, meaning 0, right? So again, you can reformat this value to make it look like 0. Okay. Now this is the most important part of this model. So here we calculate return on base equity. So in a way, you can think of it as a profitability ratio, return on equity. Now what we do, we divide C58, which is our net income, by C9, which is our base equity for test purposes for 2016. Now remember, I told you that equity, the value of equity comes from a balance sheet, and equity equals assets minus liability. So basically, what it means every organization owns something, meaning has some assets like cash, investments, deposits, accounts receivables, and so forth. So every organization, like this bank, owns something. At the same time, any organization has some debt. It owes things to other organizations, other banks, to creditors, right? So equity means assets minus liabilities, right? And once you subtract liabilities from assets, you get equity, meaning like how much you actually own as an enterprise, right? Now think about it in those slides. Let's say you own a house that is worth $100,000. Okay, so that's your asset, something that you own, okay, as an individual. However, although you own this house, it could be that you bought this house on mortgage, right? And you still owe $80,000 to the bank, the bank that gave you mortgage for this house. So in that case, the equity, that you own in this house is $100,000, meaning the value of this house, minus $80,000, which is how much you owe to the bank. So it's only $20,000. So your net worth, as they say in relation to individuals, is $20,000. Okay. So the same idea is here. They're saying, look, the reason it's a constant because they're assuming the following. Any bank should have at least 120 billion in equity. In other words, it cannot be completely leveraged, meaning owning nothing. Everything that they own is borrowed, right? So they cannot have the situation. So they're saying at the minimum, equity needs to be this. I mean, if it's greater, that's fine. Okay, and then they have net income, and they divide it by base equity. So basically, it means like how profitable the bank is. Okay, and now this is the condition. They're saying if this ratio is less than 1%, in other words, the return on equity is less than 1%, and C59 is positive, greater than 0, meaning you are increasing borrowing to meet your short-term short-term obligations in order to start the year, it means your bank fails the test, meaning it's not financially solvent. Again, it makes sense. Look, you have very low return on your equity, meaning your bank is not very profitable. And by the way, banks, I'm not talking about this bank, but in general, banks or lenders, they don't like lending money to people, to banks who don't make money, because they see it as a risk. Because if you don't make enough money, how are you going to repay their loan, right? So it means you're not making enough money, yet you're requesting for a loan to start the year. It means fail. Okay, it means like nobody will loan you any money, and your bank will go bankrupt. If, however, the return on equity is less than 1%. However, this other condition is not true, like you're not borrowing anything, then hold. Okay. However, if it's greater than 1% and no other condition applies, it means pass. It means you're okay. You have enough. You have enough profitability, and you're not borrowing anything. Okay, so, or you're borrowing, but your profitability is good enough to justify the debt. So that's a pass situation, meaning you pass that stress test. Okay, so that's how this model works. And here, you just pull those values from other sections. So this comes from this cell, right? This is your net income after tax. End of year cash on hand comes from this part. End of year short-term debt owed comes from this part, C61, and then pass or fail comes from this area of the decision model. Okay, friends, so that's it. That's it when it comes to building the decision support system itself. Now, please know there are two additional things that you need to do, and this is something that was discussed during previous lectures. The first thing I'm asking you to do, you need to generate values, as shown in your textbook for different scenarios using the so-called scenario manager. So it's not enough to build a DSS model. You need to generate those different combinations for different scenarios. In total, you have 6 different possibilities. If you multiply 2 by 3, you get 6. Okay, so you need to generate those key indicators for each of those 6 scenarios, which is like high volatility, good economic condition, high volatility, okay economic condition, high volatility, poor economic condition. So this is 3, and the same thing, the 3 involving n, meaning normal volatility. So you'll generate that, you'll generate the table as shown in your textbook, and number 2, it will look something like this. Maybe you'll reformat it better. Okay, so here we have like values. Here we have short-term debt. So those are zeros. Those are non-zero values. And here we have certain scenarios. So it's poor high, poor normal, okay high, okay normal, and then you need to add the remaining 2 scenarios. The other thing that I'm requiring you is that in addition to creating a table like that, you need to write like a short recommendation or interpretation. Like, what is your overall understanding of the situation, giving those 6 different possibilities. Okay, so you need to write like some kind of analysis here, maybe like a few sentences. Okay, and you need to submit it as an Excel sheet. The entire assignment can be fitted like in one Excel sheet with several tabs. You can build graphs, you can improve the formatting of your table, it's up to you, but it should be clear to me that you understand that those are the 6 different scenarios, and this is what's going to happen. By the way, here it's like shortened because if it's okay, this is high volatility, normal. Yeah, I think like good and okay have the same values, but I'm not sure about that. So it's better if you have all 6 scenarios side by side. So once you do all those things, just write your interpretation, your recommendation to the bank. Say like, what is that that you see giving those 6 different scenarios? What kind of recommendation can you make to the bank? Okay, and that's it. And then you can submit this Excel sheet, as your assignment. No need to create a zip file. I mean, if you want to do that, that's fine. But if you don't create a zip file, then please name your Excel file using the same naming convention that you use for naming your zip files. And that would be it. Just use the scenario manager to generate and summarize different scenarios. Write your interpretation, include your model in a separate tab, and that's it. So that's it. That's the end of part 2 of assignment 6 tutorial. Thank you for listening.